Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about economic indicators, Federal Reserve toolbox, GDP, and the consumer. So economic indicators, you have leading indicators, and those are statistics that typically precede economic events. They predict the next phase of the business cycle. So the stock market, housing, and interest rates would be some examples of those. You have lagging indicators and factors that change after economic events. Typically, it could be unemployment, GDP, and corporate earnings. What you're looking at here is the Conference Board of Leading Economic Index and comparing it against recessions. And you'll see a drop-off in leading indicators before recession. This is the 73-74 recession. You have the 90-91 recession and the infamous 2008-2009 recession. We're not seeing a decline in economic indicators today, so we do not see a recession on the horizon. Federal Reserve toolbox. So the Fed is tasked with increasing and decreasing the money supply. And they have three main tools they use to do that. You have the reserve requirement, which are deposits that are made at banks that they don't make loans on. You have the discount rate. So the Fed recently lowered the discount rate by 0.25% to 1.75 to 2%. And then you also have the open market operations. And that's the Fed buying and selling of treasuries. GDP and the consumer. Consumer spending accounts for about 70% of U.S. output. You have goods, durable goods, autos, furniture, etc. You have non-durable, which would be fuel, food, and clothing. And you also have services. And those are things that cannot be stored and they're used up when purchased. And that's now about 50% of U.S. GDP is on the service sector. What you're looking at now is the economic clock. 6 o'clock is the bottom of the economy, and 12 o'clock is the peak of the economy. As you're coming out of 6 o'clock, you're going to start to see things like rising commodity prices, declining inventories, profits are accelerating, and then rising inflation, and then the interest rates will start to climb. We currently believe we're right in between 11 and 12 o'clock. We've seen the rise of interest rates. Now the Fed is using that toolbox to keep the economic expansion going. If they hadn't used that toolbox, you probably would be on the back side of the economy and more into contraction. We use the baseball analogy. There's 9 innings in a baseball game, but it can go extra innings. The Fed is allowing us to go extra innings by using that toolbox. Thank you again for joining us for 3 and 3.